Hey everyone, it's Imran from Options Insight, your macro options daily for today. Okay, so markets continuing to go lower, failing to hold on to that 4,000 level on the S&P, which did have a lot of concentration of strikes the next Friday, but wasn't really strong enough to hold it. So now the S&P is kind of given back the entire rally that was induced by Powell speaking last week. Even Europe started to come down a bit, albeit pretty slowly, so much smaller moves. So 1.5% to 2% in US indices. We only saw about 70 odd basis points in the DAX, for example. So, heading that way from sitting up at the highs for a long time, not moving, finally starting to dribble a bit lower, but doing it on a relatively low realized vol for now. China was still firm, although it has got knocked about 2% overnight, with China and Hong Kong down as the trade data coming out of China wasn't particularly rosy. And then energy commodities still weak. So you're seeing USO got whacked, as did natural gas, as did uranium. So they're all a bunch of red on the commodities board, whereas the metals were hanging in there with small gains in gold and in copper. Obviously, silver had an amazing run last week, gave half of it back yesterday, but still remains up 4.5% on the week. Volatility-wise, we did see vols catching a bid across US and European markets. So S&P vols are up pretty heavy over the last 2 days. I think we saw like a 17 handle on front month volatility on S&P, and it's back to 21. There's a pretty big move. Obviously, it's just tracking the market lower. So as spot goes down, your new at the money vol is on a lower strike. So it doesn't mean that fixed strike volatility is up by that much, but still, the fact that the vol is managing to ride up that curve is kind of decent in terms of vol performance compared to what we've seen a lot of the time this year. Obviously, markets seem like they're feeling a bit more nervous here, heading south. European vols also catching a bid, but they were coming from a much lower base. So even with Eurostox and DAX up a vol point apiece, they're still at 16 to 17 and a half sort of vol. So they're still quite low, but then they are realizing single digits, so no one really wants to buy them unless they start actually moving, which may well happen. As we get more and more illiquidity into year end, they might actually start moving again if they have a reason to move. So kind of watch that space. Commodity vols generally higher. You can see most of them kind of in the green, except for nat gas, which continues to move down. Despite nat gas literally being down 26% on the week in spot, we're still seeing implied vol smash. Implied vol highs were near 120. It's back to 93 vol now. So that's a pretty impressive correction, but it is still realizing 67. So you've still got a positive carry of 30% in nat gas, even after the vols got obliterated by 25 vols. So it just goes to show how expensive that was. Now, personally, I'm starting to think in the 80s, this thing finds some support. I don't see this vol going below 80. Even into the quiet holiday period, I think 80 will probably be a bit of a floor. As you know, we've been short a bit of vol. We did a little bit of risk management on those trades because it was the 25% drop in a week or in a few days was starting to make us a little bit nervous. So we're still making money on that trade, where we're just trimming the edges a little bit to try and contain the risk to make sure we don't suddenly go into a loss. Okay, carry wise, you're seeing normalization in the US indices. Those numbers looking a lot less negative than they were, and that's because implied vols are catching a bid and catching up to realized volatility. But obviously, lots of positive carry in Europe, as we mentioned, and also positive carry across VIX and across the Asian indices as well. In terms of commodities, we're seeing positive carry in energy commodities and negative carry in metals still, but copper's still not really realizing. Although with copper, we were short some stuff in copper. We actually covered it yesterday because we just think copper's probably the one that's going to be the most related to what's going on with this China reopening. And so we do think copper has still got the potential to move around based on what's going on in China. So we don't really believe in being short the copper, the gamma anymore. It hasn't been a particularly great trade for us anyway because the entry point wasn't good for us. So we just got out of that trade and are happy to move on with our lives. If we look at skew catching a bid in US and Europe, and DAX skew actually starting to look, I wouldn't say expensive, but a lot higher than it has been recently. So you can look at these percentile numbers. A lot of these percentiles were like pretty much near zero. Some of them still are in single digits, but DAX stands out at 24% with the skew at around 6 volts. So for whatever reason, DAX skew is catching a bid. So people are worrying or hedging the DAX, especially relative to S&P and Nasdaq, which are still at around 4 vols, and those are actually moving around, and those are feeling pretty bearish when the market drops, whereas DAX is like down 70 bips. So some divergence there in those skews, and not really in line with what we're actually seeing in the markets. In terms of other skew moves, we saw Nikkei and Nifty skew getting hit. Nifty skew's actually gone negative now, which is pretty rare for an equity index, but Nifty really just moves up consistently on a low realize and just never drops, which is why that skew over a long period of time is kind of flattened to close to zero. And then finally, oil skew finding a bit of a bid again, as well as oil spot breaks down and kind of spooks people there, breaking through that last area of support and kind of potentially opening up a lot more downside, although the fundamentals you think are still probably going to be okay. For now, the spot market hates it and keeps going lower. Anyway, quickly looking at the other asset classes, FX was quite muted. Dollar did have a small bounce, but in terms of the kind of moves we have been seeing lately in the dollar, it was a pretty benign move and not really a convincing bounce. Bonds are still very firm. TLT was up 1.3% on the day, kind of recouping all of the loss from the day before. So bonds really kind of decoupling and decorrelating from equities, and HYG was a bit softer in line with the stocks. In terms of sectors, worst sectors were ARC and XLE energy. Obviously, energy tracking what oil's been doing, and ARC just a bit of a volatile beast. Obviously, Nasdaq was down 2%. ARC tends to do double that. We talked about that in the daily note yesterday. So ARC really kind of suffering there and kind of not really enjoying the general sentiment in markets. Okay, implied vol wise, not a lot to call out. Sector vols caught a bit of a bid, as did bonds. FX vols were muted, except for dollar Canada, dollar CAD, because they've got their rate decision later today. So that's obviously caught a little bit of a bid in case they surprise markets with how much they hike or don't hike. And then not a lot to call out in terms of skew in these sectors, apart from maybe TLT skew flipping to negative. So typically that has been for puts for a large part of this year. It's now flipped towards calls. So calls trading at a premium to puts right now in TLT because this bond rally is really starting to gather some momentum and people are thinking it might have some room to run. On that note, the reason why bonds are rallying and they seem to be decorrelating from stocks, you can see here, the last 4-day change in SPY and TLT, if we compare those ETFs, you can see that they kind of track each other pretty well, or they have done for most of this year. We've seen quite a big divergence recently where SPY is down about 5%, 4-5% over the last week or last 4 days, and TLT is up around 3%. So you don't tend to really get these things diverging quite the way they have done. And this breakdown in correlation is not really typical for this year because inflation's been the dominant concern for stock market participants, right? So it seems that bonds and the yield curve, which is now the most inverted it's been all year, and also the most inverted it's been in 40 years, and you can see that here, and I've pulled up the 3-month versus 10-year, which is the one the Fed says they look at. That's at minus 78 basis points, right? So it's gone deeply, deeply inverted. So it seems that the curve and yields in general are starting to price in a recession for next year. Okay. Now, this has previously been a reason to buy stocks on the assumption that if we get a recession, then that forces the Fed to pivot. But something seems to be spooking stocks right now. We're not getting that same dynamic this week, right? So I think the market might finally be cottoning on to the idea that a recession has to be allowed to happen to create enough pain to meaningfully break the back of inflation. So it's not the first sign of a little recession. They're just going to completely reverse course, right? So that means no early pivot. That means a load of job losses. It means lower corporate earnings, and it means less passive money flowing into stocks next year. So that is what we seem to be transitioning slightly into that dynamic. Now, clearly, we've got big catalyst next week. CPI comes in light. All the algos are going to buy the hell out of the market, and you're going to see a big spike. But in general, if we look past the noise of whatever we're going to get next week, and we look into the next quarter or two, I think we are going to get this shift in dynamic where equities are not in love with the idea of recession quite the way they have been over the last few months, because they keep calling that a reason for a pivot, basically. So starting to see a sniff of that in the market. Let's see if it plays out that way. All right, so outside of that, ideas-wise, we're seeing some value in uranium. Okay, so we're looking at a commodity dashboard, and we're seeing, obviously, called out a few weeks back that we thought nat gas was expensive, which is why we sold it. But we also thought uranium was cheap. But at the time, this uranium, this sort of blue cross, was somewhere in the middle here, right? So spot prices were a bit more neutral in uranium, but vol was cheap. So, and we were thinking we're going to sell nat gas and maybe we're going to buy some uranium against it because it's cheap and it could it act as a bit of a hedge. The reality was, looking at the correlation between nat gas and uranium, there was no real correlation, so it wasn't really a hedge. And all the juice in that trade really was to be short nat gas and not really long uranium. So I just sold the nat gas leg instead, because that was really where I thought the edge was. Now that uranium has sold off and we're kind of at the lower end of the range, if we look at the range on uranium, we can see it's been pretty range bound since the summer, right? So it trades in this quite wide trading range of around 20%, and it's kind of come back down to the lower end of that range. So the three assets I've got up here are URA, which is uranium ETF, the Sprott physical uranium ETF, and CCJ, which is Cameco, which is one of the biggest miners of uranium. Okay, so though you can see that whilst they're not perfectly tracking each other, and CCJ kind of seems to have a bit more beta when this thing rallies, in general, they're tracking each other pretty well. And you can see here, I've got the correlation here. It's around 90%. That's the short-term correlation, like rolling 30-day correlation. It's kind of been around 90%. It did drop down to about 70 because there was some specific stuff going on in Cameco earlier in September, October time. But in general, for the most part, it correlates at around 90%. And it's got a raw beta of around 1 to URA. Right. And also, if you look at the makeup of that ETF, Cameco makes up 21% of that URA ETF. So anyway, so those are the three assets that I'm kind of tracking to keep an eye on what uranium's doing. And because spot is quite low in the range, because volatility is quite low as well, I think there's some value in buying some upside calls to play, a bounce or a mean reversion. And also, fundamentally, I'm just bullish uranium and have been for a while. So when I get entry points like this to get into this sort of exposure, then it suits me because it also marries up with my fundamental view. Now, due to the poor liquidity in uranium options, in URA options, we had a look at those, and really the idea is I want to feel that when I want to exit this option, I'll be able to do it without paying too much bid offer spread. And I just want the general day-to-day volume and activity to be big enough to feel that this is a liquid instrument that I'm using. So it seems that Cameco is a much more liquid options market. And like I said, because it's correlated so strongly to it and it moves kind of in line, I'm happy to use Cameco options rather than URA options because I don't think they're that liquid. Okay. So then looking at URA and the volatility conditions are very similar. So kind of I had a look on the old Bloomberg terminal to see if the vols are as low in their percentile ranges as they are in URA, and it does track very well. Not just the spot, but the volatility complex tracks quite well as well in CCJ. So you can see here we're in the buy calls territory on the strategy compass. Realized vol's pretty decent. It's kind of realizing in line or slightly better than it's implied. You can see that by waiting a month or so, those implieds have continued to drift lower. So we've done well there. We've kind of, you can see these crosses have not bounced. They've kind of gradually been drifting down and this way. So that's saying the vol's been eking lower and the spot's obviously been going lower. You can see the term structure is kind of here. It's got a little bit of a spike in the weeklies, obviously, but then because we had a reasonable move just now. But in general, you can see the term structure is slightly upward sloping. So the thing we've landed on, the trade that we already executed yesterday, is, look at this slide. You can see energy's up 50%, mining's up 20%, but the next best few sectors are the defensive sectors, right? So people have managed to preserve some capital by parking themselves in utilities, healthcare, and staples. They're practically flat on the year, whilst most other sectors have been trashed. Financials down 10, tech obviously down 25, retail down 30. So the idea is, if we do go into a recession, and if money needs to be taken out of the market, i.e. liquidations occur, less passive flows, people need to sell their stocks to just generally get on with life and survive, then what are the stocks that people are parked out in, right? And the idea being is these defensive sectors, whilst they've outperformed as the market rotates into the idea that recession is coming, when the actual recession comes, if the bear market has another leg down, these sectors are going to be extremely vulnerable and they could actually have quite a big down move given that people are parked out in them. So something to be aware of, something to think about. I haven't executed any trades myself yet, but I do know that healthcare skew is relatively flat, and some of these defensive sectors may have some relatively flat skew. So maybe there'll be some opportunity to own some downside in those some point next year. All right, that's it for today. Good luck out there. Catch you all tomorrow.